Hello guys, this is Harsh Baldava, and today in this video we will be performing a DCF, that is discounted cash flow analysis of the company DMART. So let's get started. Okay guys, so here you can see this Excel file where I have performed the financial statement modeling of DMART or discounted cash flow modeling, and at the end I got the per share value as 2910, which is quite near to the current share price of 2850. So let's get started as to how I did this. Now, first of all, discounted cash flow analysis is all about forecasting, right? It's forecasting the FCFF, which is nothing but the free cash flow to the firm. So how do we do this? Okay, so the number one thing is to first put in the historical data, such as revenue from operations, cost of goods sold, which you will easily find in the annual reports and on various websites such as screener.in. Okay, so the first thing we are going to do is put in the data for revenue from operations till 2021. The letter A signifies actual and the letter E signifies estimated. As we have data till 2021, we will be putting it here in the Excel file, and then we are going to calculate the growth in revenue on an year on year basis. So as we can see, the growth in the revenue is 38.61% for 2017, and the formula is very simple. It's nothing but 11,897 divided by 8,583 minus 1. Okay, note that this I'm not gonna go into much detail as I have to make this video short. I'll be just giving you an overview of the whole analysis. Okay, so the growth rate is 38.61% and 26.36%. Just drag it along, okay? And now to estimate the revenue from operations for 2022 and further, what we have to do is we need to calculate the average growth rate. Okay, so just put in the formula of average growth rate and you will be getting it as 30.59%. Okay, now one more thing is that I have excluded the growth in revenue for 2021, as we know that this is an abnormal year, right? This is not a normal year. The pandemic broke out in this year, and this event is basically, you can say, an outlier. So we should not account for these kind of events. So I've taken the average only for these for growth in revenue. Okay, so I've taken the average only for these four cells, not this one. So the average comes out to be 30.59 percentage, and you can just assume it for all the years from to 2022. The next thing is the cost of goods sold and other expenses. Now if you subtract the cost of goods sold from revenue from operations, you will be getting the gross profit, and if you subtract from the gross profit the other expenses, you will be getting the EBITDA. So what I have done is I have just clubbed it, so directly we can get to the EBITDA point of view. Otherwise normally it happens is first they subtract the cost of goods sold from revenue from operations, which gets you the gross profit, and then they subtract the other expenses, which gets you to the EBITDA. I have just clubbed both of them. After clubbing, okay, so the next step is you have to find the cost of goods sold as a percentage of the revenue from operations, which is nothing but simply this divided by this. So as we can see, it's 92.3% in 2016 and 91.7 in 2017 and so on. Now the average percentage over here is 91.84%. So simply you can estimate the cost of goods sold by multiplying 91.84% with the estimated revenue, right? So you will get the cost of goods sold for the years for all the years after 2021. Next thing is calculating the EBITDA, which is nothing but revenue from operations less cost of goods sold less other expenses. So you get the EBITDA for from 2016 till 2025. Next will be calculating the depreciation, Again, you can estimate the depreciation as a percentage of the revenue from operations, and you can take the average percentage and simply multiply this average percentage with the estimated revenue, and you get all these figures for depreciation as well. So as you note that everything is a percentage of the revenue from operations. Okay, next thing is calculating the net operating profit after taxes. Okay, so the tax rate has been lowered down to around 25%, so we have assumed it to remain the same for the further years. And the EBIT is 2175 less 25% of it, it's 1631, and so on. Note that we have not removed the interest component, that is the I component in EBIT, because we are calculating free cash flow to the firm and not free cash flow to the equity. Okay, there's a difference. So that's why we'll not be removing the interest component. Okay, because it's to the firm and it's free cash flow to the firm, right? So the firm includes the creditors as well. Okay, it includes the equity holders as well as the creditors, so we should not subtract the interest component. And then we have to add back the depreciation. Okay, as we are calculating free cash flow, the formula is net operating profit after taxes plus depreciation less the working capital investment and less the capital expenditure. Okay, so once you add back the depreciation, you have to subtract the working capital investment. Now how do you estimate the working capital? For that, what you have to do is, first of all, you have to put in the historical figures for accounts receivable as well as for inventories and accounts payable. Okay, and then you have to calculate accounts receivable as a percentage of revenue from operations, because it is related to revenue, right? So you get all these percentages, and again the same method, you have to calculate the average of all of these percentages, which comes to 0.18%, and just simply multiply this 0.18% with the revenue that you got in 2022. Okay, is that clear? Yeah, so simply do that for these years. And for inventories, you have to calculate inventories as a percentage of the cost of goods sold, which is nothing but 672 divided by the cost of goods sold, 7919. Okay, so just calculate the same for all the historical figures and find out the average percentage. Once you get the average percentage, just multiply the average percentage with the estimated cost of goods sold. Okay, so accounts receivable is basically a percentage of revenue from operations, inventory is a percentage of cost of goods sold, and accounts payable is also a percentage of the cost of goods sold. Now to calculate the working capital, the formula is very simple. It's nothing but accounts receivable plus the inventories minus the accounts payable. Okay, this plus this minus this. Cool. So you get the working capital for all the years. Now you have to calculate the change in working capital, which is nothing but 708 minus 486, then 880 minus 708, which comes to 172, then 1210 minus 880, which comes to 330, and so on. So as this is a positive figure, means we have to invest in working capital, right? Okay, so it's an outflow of cash basically. So that's why we are going to, as you can see over here, we are going to subtract the working capital investment 218591. These same figures from 2022. Okay, so we are subtracting the working capital investment. The next is capital expenditure. Now what about capital expenditure? Again the same thing, you have to take capital expenditure as a percentage of sales. How did I get this capital expenditure? Simply go refer to the cash flow from investing activities in the company's annual report, and you will find something called purchase of fixed assets. Okay, so that is nothing but the capital expenditure. You will find it in cash flow from investing activities in the annual report of the company. Simply find it as a percentage of sales, which you get as 5.42%, and just calculate the average of all of these, which comes to about 6.78%, and again multiply this with the projected revenues. So after we are done with the capital expenditure, we can simply find the free cash flow to the firm by using the formula which I mentioned earlier, which is nothing but the net operating profit after taxes, add the depreciation, subtract the working capital investment and subtract the capital expenditure, and you get the free cash flow to the firm. Now what we have to do is discount these free cash flows to the firm to the present. Okay, and for that we need a discount rate. Discount rate is nothing but the WACC. WACC is weighted average cost of capital. So to find out the WACC, first we have to find out what is the capital structure of the company, meaning what how much equity the company has and how much debt the company has. So if we see over here, the total market capitalization, that is nothing but the market value of equity, is 2850, which is the last traded price, into total number of shares 64.56 crores, which comes to about 1,84,651 crores. This is the market value of equity as on today, May 11th. Okay, and then we have the short term, we have the book value of debt over here. Now, for companies which have issued bonds that are marketable, you can take the market value of debt. But right now, as we do not have much information, we will be taking the book value of debt. So the short term debt is that debt which has to be repaid within 1 year, and the long term debt is the debt which has to be repaid after 1 year. So the book value of short term debt is 527 crores, long term debt 366 crores, the total comes to 894 crores. To find the weight of equity and debt, simply just take the equity value divided by the total of the equity value and the total of the debt value. So you can see see the formula over here, d phi divided by d phi plus d9. Okay, so you can see equity constitutes about 99.52 percentage of the capital structure and debt constitutes only 0.48%. Now, as this is almost a debt free company, we can safely assume this, that the weighted average cost of capital, okay, is equal to nothing but the cost of equity. Why so? Because the proportion of debt in the capital structure is so small that even if we account for this, it won't make any significant difference to our analysis. So we can simply take the cost of equity, okay, as the cost of capital. Now how do you find this cost of equity? The cost of equity is nothing, can be found out by the CAPM, that is the capital asset pricing model. What does the capital asset pricing model say? That is, the required return is the risk free rate plus the beta of the company into the market risk premium. How do you get the risk free rate? The risk free rate can be assumed as the United States 10-year treasury bond yield, which is at 1.6%. 1.6% plus the beta of the company, that is beta of DMART. You can find this figure in Yahoo Finance or anywhere. This is the 5-year monthly beta. Okay, so 1.60% plus 0.11 into 5.5%. Why did I take this 5.5%? This is usually assumed to be the market risk premium. What is the market risk premium? The return, the excess return that the investors expect when they invest in a risky asset, that is known as market risk premium. So the risk free rate plus the beta into the market risk premium, which is nothing but 5.5%, gives you the cost of equity to 2.2%. Okay, so here we find the cost of equity. Now what we need to do is find the terminal value. How do you go about finding the terminal value? As we see, this was our last projected cash flow. Now as per the going concern principle of accounting, we have to assume that the company will go on forever till infinity. So we have to get now we can't just calculate cash flows till infinity, right? So we need to find a terminal value. The formula for terminal value will be the 2025 estimated cash flow into 1 plus the infinite growth rate. Now you have to assume this infinite growth rate, but beware of one thing, you can't assume the growth rate to be greater than the cost of capital that you have calculated. Our cost of capital is 2.2%. So you can't assume the growth rate to be greater than 2.2%. So I've assumed it at 1%. So 2025 estimated cash flow 2384 into 1 plus 1% into 1 plus 1% divided by 2.2%, that is the WACC, minus 1%. So that value comes to around 199804 crores. Okay, so what you have to do is simply add this and this, simply add these both values and get the total of them, and now discount these four to present, that is today. Okay, so you can do this by using the NPV formula. In NPV formula you have to mention the rate, that is nothing but the cost of equity, cost of capital, and the range of the values or the cash flows. Okay, so by that you get the enterprise value. Now you have to calculate the equity value from the enterprise value, right? So what is the formula for calculating equity value from enterprise value? It is nothing but enterprise value plus the non-operating assets, which includes cash, minus the total debt. Okay, so enterprise value plus cash, and bank balance is nothing but cash, and these are the non-operating assets. Okay, so enterprise value plus these all gives you this, then subtract the total debt, then you get the equity value. Okay, equity value is nothing but 187819, and when you divide 187819 by the total number of shares, what are the total number of shares? As we calculated over here, it was 64.56 crores. When you divide it by the total, when you divide the equity value by the total number of shares, you get the answer as 2910. So as we have got this difference of 60 rupees, which is nothing but the share price value that we have got 2910 minus the current market price 2850, we can say that the company is undervalued. However, this analysis is not perfect, as I have made various growth rate assumptions as well as assumptions regarding the cost of capital. This whole thing was to just give you a basic idea as to how DCF analysis is carried about. Now I would want you to please take note of a few things. Number one is, in this case there are no options and warrants. Now what are options? Basically they are the rights. Okay, it is the right to purchase the company's share at a particular price in the future, and they are usually given to employees and are called employee stock options. In case options were there wherein the employees could purchase the stock in the future at a particular price, the number of shares would have increased, right? So again, if the number of shares would have increased, the equity value would have increased. Now when will the employees would want to exercise their options? They will exercise their options only when the price at which they are allowed to exercise the option is less than the current market price. Let's say if they are allowed to exercise the option at 2700, so they will go ahead and exercise it, because if they go and buy the share in the market, it's costing them 2850, but through the option it's costing them only 2700, right? So first we have to see the value of the option, and if it is less than the current market price of the share, we have to account for those options also in calculating the total number of shares. So this would increase the total number of shares. However, to keep things simple, I have taken a company which doesn't have any options, warrants, and which also doesn't have any debt. Otherwise, a lot of calculation goes into calculating the cost of debt as well. And another thing that I would like you to keep in mind is, whenever you're putting historical figures for revenue from operations, do not include other income. There's a thing called other income in the annual report. First go and check in the notes to the financial statement what that other income comprises of. It is usually income from non-related activities, okay, activities which are not related to the business at all. Now you might say, why have I included other expenses over here? If we have not included other income, why are we including other expenses? When you go and check the notes to the financial statement, you will see that other expenses constituted of selling and general administrative expenses. So these are related to the business, these have to be included. So you have to understand what activities constitute business activities and what constitute non-business activities, and accordingly do your analysis. So I hope everything is clear for you, and I had to make this video short, as if I go into detail it would take at least 3 hours. And if you like the video, please hit that like button, and also put in any doubts you have in the comment section. I would be very happy to answer them. So thank you. Please like, subscribe.